Welcome to Activist MMT, a podcast about real-world economics, including modern money theory, and how life changes when you discover it. I'm your host, Jeff Epstein. Today's a special video episode of Activist MMT with Sam Levey on the basics of math and economics. This is Sam hand-holding me through the opening chapters of Wynne Godley and Mark Lavoie's 2016 book, Monetary Economics, an integrated approach to credit, money, income, production, and wealth. The specific paper we focus on today is the 2006 paper by Godley and Lavoie called A Simple Model of Three Economies with Two Currencies, the Eurozone and the USA. The longer-term goal is to understand the concepts in this paper via its math. For this conversation, however, the much more important goal is to use this paper as an excuse to learn the basics. In other words, I'm not reading to learn, I'm learning to read. This is actually the first in a two-part video series with Sam on math and economics. The second is guest hosted by Jonathan Wilson. Jonathan and Sam go much farther and deeper, and it's centered around Sam's most recent paper. They also bridge the gap between the math used by MMT and post-Keynesianism and that used by mainstream economists. A final note, my conversation with Sam was originally intended to only be a half hour long and in private. Thanks to Sam's generosity and blessing, it's turned into something much more. A big thanks to Sam for all his time and patience. And now, on to our conversation. Enjoy. So just briefly, I'm in Torrance. I mean, I don't know what you know or don't know, but
how's it going so far?
It is awesome. It's incredibly awesome. I'm in a high-speed introduction to MMT, and I'm writing my second assignment right now for the first course. The first one was 1,000 words. This one's 3,000 words. I have one question for you. And I'm surprised that the assignments seem to me to be above and beyond the coursework, meaning like they don't, like the week that the assignment is due is not cleared in any way. It's just as busy as every other week. And so the assignment is like double on top of that. And I'm assuming that that's kind of just what a master's degree is. I don't know, but suicide has been contemplated by not just me.
I'm going to say it varies a lot by instructor and subject. Some graduate courses, are like really intense, a lot of reading, a lot of work, maybe a lot of writing, and others are a little more lackadaisical. It's all over the map, I'd say. And the justification there is like, on the one hand, you want to learn a lot at a high level, so there's a lot to do, so some classes are really intense. On the other hand, you're also like generally considered to be more responsible for your own learning, the farther you progress. And so some other courses are like, the instructor's like, I'm here to point you in the direction that you want to go, and then you can figure out the rest on your own, like, and so there'll be like not very much formal structure, but like, yeah. So I've seen it varies, is what I'm saying. That's all.
All right. Well, it's amazing. It is really amazing, and I'm learning a lot. So anyway, yeah. Okay. So I fought through the first 15 equations here, and it's hard for me to say I basically get them, and I've even done some algebra to confirm that I can go back and forth between like some of the things here, but I've only gotten up to the first 15. In number 16, and it starts introducing Greek letters, and it's nothing like really obvious that is saying what these Greek letters stand for, and I'm lost, and it seems like
okay.
kind of a whatever. I don't know what to do at that point. I don't understand at that point. And obviously I can't get too far in the paper, you know, when I've reached that roadblock. So in equation 16, 16, it introduces I think it's an alpha. And then, you know, 39, or for 39A, it's mislabeled as 49A. 39A introduces I don't know what that is, symbol. And then there's a third one, whatever. I don't understand what this means. Everything before then, I kind of have a grasp on, although it's hard to confirm when I can't even continue the paper. So
you want to just start at the top? We can work through it.
Sure. Well, I can. Yeah, I'll say what I understand.
I mean, either way, yeah, that would be great.
All right, I'll say what I understand, and then you can fill in the blanks or whatever. Yeah. Okay. So one is, so there's three countries denoted by $, hash and ampersand. The hash and the ampersand represent 2 euro countries using the same currency. So the $Y equals consumption of their domestic consumption plus their domestic government spending plus their domestic imports and exports and imports. And then the same with each of the other 2 countries. So that's enough of that, I think. And so going to 4. And now we're at the YP. I wrote notes. So I don't have to think about this.
That was up here, I think.
YP's personal income is the GDP of the nation plus the interest rate of the nation plus the bills of the households that are owed to domestic companies plus the interest rate of hashtag Euronation, the interest rate in the hashtag Euronation times the bills owed by U.S. companies to that country. And then the same thing with the third country. And then there's the XR. I do have it here. The change in the interest rate multiplied by the bills owed, denominated in the issuer's money. So that's roughly what those formulas are saying. I believe that's close. If you wanted to say anything about that, otherwise just go on to 7.
So YP, did you catch what YP stands for here?
Personal income of households in the United States.
And so there's basically 3 sources of income, or like 3 categories that income comes from here. So did you pick up on that?
3 categories. One is the GDP.
Yeah, so that's like, selling goods
and
services.
Bills. Okay, and so the bills owed to the United States is also income to United States households.
Well, so this bit here, this is the interest on these 3 different assets. So actually, wait, did you look at the tables, the transaction tables, these guys?
Some.
Okay, why don't we start there? Let's back up to this table here.
Page
so
3.
Okay. These SFC models, these stock flow consistent models, or they're called stock flow consistent models. I think that's a bad name. I prefer the term flow of funds models, and you'll hear that occasionally, but the SFC term is kind of stuck.
Okay.
But they always have these tables. So one of them is like a balance sheet, right? So these are showing like assets and liabilities. And then the other one is this transactions flow matrix. It just shows like things that happen in the model. There's consumption, that's this line. Taxes get paid, that's this line, right? Interest payments, things that happen, right? When money moves around or things move around in the model, that's this table. So the balance sheet is like your static at one moment in time table. And then the transactions table is like how things move and change table.
So for example, the top left corner is consumption for households in the United States means that, what does that negative C mean?
So the negative sign is indicating that the households are spending money. And so
money is moving from households to firms. That's what that's saying.
Yep, that's exactly right.
Okay.
And one thing to note that you can read off this table is that the consumption only happens within a country, right? Because you can see like C $, U.S. households spend that, and then U.S. firms receive that.
Okay.
And then in the other countries, they each have their own separate, right? C pound and C pound, households and firms in that country, C at and C at, households and firms in that country.
Okay, that's clear. I understand that.
Yeah. So let's, I guess we can keep doing this. Well, wait, we should probably do the other table first because that one's going to reference this one. So H and B and V, have you picked up what those mean?
Okay. Household money goes up. Wait. I don't understand this is static. This is a snapshot. So no,
Yes.
I don't understand what plus and minus means in this context.
Okay, so what it's indicating is that the minus sign means it's a liability, and the plus sign means it's an asset.
Okay.
So H, did you pick up what the H stands for?
Household income.
Not quite.
Or not savings.
That's warmer.
Okay. No, I don't. I'm not sure.
It's money. And I think it's H. I think the reason they use H is like it's high-powered money. It's cash, okay. Right? Actually, you can see that here, cash.
Okay.
And so what this is saying is cash. The minus sign means it's a liability. So dollars are a liability of the Fed, and they're an asset for the household sector.
Okay.
Okay, and then these next few rows here are bills, right? B for bills.
Mm-hmm.
And because we have 3 countries, we got 3 kinds of bills, right?
Yes.
So
bills from the U.S. to the U.S. The government is a liability of those bills, I guess. Liability.
Yeah. So in each one of these rows, you'll see there's one entry with a minus because only, you can only an instrument can only be a liability from one person, right? It's like somebody is the one that issued the liability.
Yes.
So for the dollars, it's the U.S. government. And then over here for this one, it's the pound government. Mm-hmm. And for this one, it's the at government, right? Mm-hmm. But then a lot of different people can hold that asset, right? Some of the bills that the U.S. government issues gets held by U.S. households. Some of them get held by the Fed. Some of them can get held by households in the pound country. Mm-hmm. These are holding bills issued by the U.S. government.
Yes, I understand that.
And same with the other country and with the central bank in Europe, the ECB.
Okay.
And so
is this suggesting?
Yeah, go ahead.
Is this suggesting that the bills are only owed to the government?
Yeah. Well, it's just like if you're talking about some IOU, right? Who issued that IOU? It's only one person can issue it, but then if there's more than one, it can be held by lots of different people.
All right. So then I'm not what I don't understand yet is on the transactions table, it shows households consume and firms earn that money through, they buy something from the firm. A household consumes from firms, but on this table, why is there no firms, I guess?
That's a good question. The reason, I'm pretty sure, is because what they've done is they've made a simplification to the model where they're assuming that the firms have no long-term assets. So what you find is if you take this firms column in the transactions table, so this is saying like firms receive money when there's households consume. Firms receive money when the government spends. Firms have to pay other countries, they have to pay when they import stuff. Firms also sell the export goods, and so firms receive money when the country is exporting.
Okay.
And then firms are going to pay out all that money. Sorry, this
as
won't
income.
Let me highlight properly. Yeah,
as income.
Exactly.
Yeah, that we discussed this part. This was the inspiration of my wanting to interview you, actually, of income equals savings, and that it only passes through that. Yeah, what you're saying now is evocative of that. Sorry.
Yeah. So one of the ways you can see that on this table is that all of the columns in the table sum to 0. You see this last row here, this sum. Yes. So that's telling you could write an equation by doing like plus C plus G minus IM plus X minus Y equals 0.
Yeah.
So you can read equations off this table, right?
Okay.
And so so this is telling you that all the income that the firms receive gets paid out of the firm when it as income to households, which they receive that right here.
All right. So to be clear,
Oh, sorry.
this is assuming that firms don't keep anything. They pay everything out to households, which
Yep.
is why
So
there's only households on the previous table.
exactly. So you could say
Okay.
there's no retained earnings. If
Okay.
firms had retained earnings, so money they keep, then you would need a column here for firms, and you'd have to show that.
Understood.
Yeah. All right. So you got we were doing the bills before, and we kind of said, right, there's one minus sign in each row. That's the issuer of that instrument. And then there's a whole bunch of plus signs depending on who's holding it. And then, so there's 3 different kinds of bills, one from each of the governments in the model. And then the last row here, or second to last row, I guess. Oh, sure, now it lets me highlight. You see that here?
Yes.
That's net worth.
V is just value.
Yeah.
Okay.
Yeah. For some reason, V gets used to mean wealth kind of regularly in economics in general, I guess, especially post-Keynesian economics, I feel like. But yeah,
Okay.
V here means wealth or net worth or value. And so what, like, you can, the same way you could read equations off of the other table, you can read equations off this table too. So like, you can read off the column, like, and this, if you do a column, you end up with an equation that describes the household balance sheet, which is like the households,
Oh.
have money, and they have these 3 different kinds of bills. And then if you subtract their net worth, you get 0.
Okay. Excuse me for 1 second.
Mm-hmm.
There's a package in my bag for you. Sorry.
Yeah.
Just repeat that last thing, please.
Yeah, sure. So you can read equations off this table. And if you look at the columns, you get, like, if I look at this US household column, and you read it off and you write an equation, you get an equation that describes the household balance sheet.
Okay.
So it's like households. Yeah.
Vertically, it seems clear.
Okay.
For example, one example of that, it seems every row except for net worth makes sense. The net worth row, I'm not clear on what that means. Everything is negative except for XR, which is that's not a bag of money. That's
This
ratio.
is the exchange rate.
Right. Exchange rate is a ratio.
Yeah.
Oh, yeah, it's a formula. So how does that add to 0 when it's all negatives and a formula?
Really good question. So this column does not add to 0. This would just give you like 4 times the exchange rate, which would be meaningless. Mm-hmm. So this is sort of separate from the way the rest of the columns work. Right. And then for rows, what it's telling you is that the stuff on this side, the left-hand side of the table, is measured in a different currency than the stuff on the right side of the table. And so if you wanted to add them, if you wanted to add across the table, you would not get 0 unless you factor that in.
Okay, but still, it's on the net worth row. It's all negative. So how would that add to 0?
That's because although there's a minus sign here, these numbers might not necessarily be.
It might be a negative number, which times negative equals positive.
Exactly right. So probably the way this is going to work out is that the government's net worth is going to be negative, and then the household net worth is going to be positive.
Okay, that's clear. All right.
Yeah, that's cool. So the beautiful thing about these models is if you just by understanding the tables alone, like look at how many equations that just generated, like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, right? You got 15 equations from reading this table.
What's this corner 0?
That's just,
oh, the zeros equal 0.
Yeah, exactly.
Okay. All right. Wow, that's new. Okay. All right, good.
And then it works the same way on this table here. All the rows and all the columns add up to 0, and it gives you equations.
Okay. Let me ask just a brief aside, and you don't have to. I feel like this. Where do you learn this? Where do you learn this from a basic level? I mean, I don't know of any books that walk me through like what you're walking me through, or class,
well,
or.
Let me find the book for you.
Oh, this is the Lavoie Godly Lavoie book?
Yeah, I think.
All right. I gotta get that.
Yeah. Anyway, so
Oh,
yeah,
okay. So
same thing
we're back
here.
now.
Yeah, same thing here. You can, so in if you read, so this is a transactions table. If you read it horizontally, it's showing you like things go from where to where, right? When the household spend money, here's sorry, when the household spend money, here's where it shows up.
Mm-hmm.
And then if you read it vertically, it's showing you like all the things that happen with whoever you're talking about, right?
Mm-hmm.
Like households spend money on consumption, they receive money, they receive income, from GDP, they pay taxes, they receive interest payments. So like these ones, each of these three rows right here is showing you like the household, okay, how much interest do they receive on their dollar government bonds or bills or whatever? It's the number of bills they have times the interest rate on those bills.
So bills in this context is not something I need to pay. It is a bond or money.
Yes, yeah, sorry. It's like government bills, which are short-term bonds, right? Like when the government issues like 3-month bonds, those get called bills.
But in the context of the equations that we were just talking about, these are, I thought, bills that we're paying to companies. But that's, I guess,
No,
not.
same thing. Same in this whole model, everything in this paper. In fact, more often than not, in macroeconomics, if somebody says bills, they mean government bonds. There's like you'll hear this. There's like three.
Oh,
You'll
that
hear like
changes things. Okay.
you'll hear like bills. There's three words you'll hear here. There's bills, notes, and bonds. And like technically speaking, all three of those are bonds. But sometimes like bills might mean like 3 months to 1 year, and then notes will mean like 2 years to 10 years, and then bonds will mean like longer than 10-year maturity, so like a 30-year bond, right?
Okay. That
So
makes sense.
it's a little tricky because sometimes people will say bonds to mean any of those. You might say a 3-month bond, but other times people will be really specific, especially like finance people who actually trade these things will tend to be more specific. And if they say bond, they mean like a 15, 20, 30-year instrument. And if they say bill, they mean like a 3-month instrument.
Okay, that makes sense. I had in my head that these were actually bills were basically consumption. It was the result of consumption or whatever. But that okay.
Gotcha.
All right. Okay. Anything else regarding that?
Yeah, so these three rows here are the interest payments received by households on the bills that they own, right? And they own three different kinds of bills because there's three different governments. And then so I just went through like here's the money they spend and here's the money they earn, and then that shows up in the changes in the assets that they hold, right? Because if you spend money, it had to come from somewhere, so that might be like a change in your cash balances. Or if whatever, if you receive some income, you might park it, you might choose to save it in the form of government bills, so that would be a change to your amount of bills.
So this change is, so everything above the changes is what happened this year, is how much I spent. I guess I don't understand what the difference between like negative C dollar sign is versus isn't the change just, the change is a reflection of all of that stuff added up together, I guess. It's
Yeah,
not
that's right.
just the
I mean,
consumption.
you can think of it this way, right? If you spend money, then you have to have less money now. And so there's an equation that indicates that.
And okay. All right, I don't know what the questions are with that, so I don't want to push that too hard.
Well, no, I mean, here, like it's like you can receive some money in the form of income. So this is maybe why here is like your income from work, right? And you can spend some money, you buy food or whatever, that's your consumption. And if there's some difference between those two, like maybe you earned more than you spent, then your savings are going to go up. And so that might take the form of maybe you have higher money balance now, or maybe you choose to invest that in bills, so you have a higher, you have more bills than you did before.
So okay, so this is a transaction table, but those changes are basically reflecting a snapshot of all of those transactions. It's the total changes over the year of all of those transactions.
Yeah.
Yes.
Yeah, that's
Okay.
right.
So that all of these things that I'm pointing, the C, negative C plus Y minus T, the interest on all the bills in the different countries,
Yep.
all of those things added together are the bills. So the H, I would presume, is the total of all of those things.
H is money, is high-powered money or cash.
Oh, it's okay. So is there a simple way to? All right. So it would be nice to see. I can see you.
Okay, let me draw my board here a little bit. I think I can clear it out. Wait, how do let me stop the share somehow?
Just I probably there you go.
Okay. So get a marker that works. I know I have one somewhere. I think there's just too much stuff on that table. Let's just simplify it, right? So
okay, I'm gonna actually remove.
Okay. So here's your income, maybe. Sorry. Your income, Y.
Yeah.
And let's suppose this is your only income that you earn from work, right? And then let's just keep it simple and we'll say, here's your spending. We'll call it C for consumption.
Okay.
And so if your spending is exactly equal to your consumption, then we're good. You earn some money and you spent it. But if you spend less than you earn, then that's got to show up somewhere, right? And so we'd say, maybe to keep it simple, we'll just start with, if you spend less than you earn, then you have more money now. And so we'll call that the change, delta for change, in H for cash, for high-powered money.
It's pretty hard to see, honestly. So that's a little better. Okay, so Y minus C equals change in H.
So this is saying if you spend less than you earn, then your money will increase.
Okay, so Y minus C, so 10 minus 5, I earn 10, I spend 5, so change H equals 5, positive 5.
Yeah. On the other hand, if you spend more than you earn,
so I earn 5,
you have less money.
Spend 10, change delta H is negative 5.
Yeah, exactly.
Okay.
So that's that. But then, what the table does is like, okay, there's other ways you can earn money besides just, your labor income or whatever. There's also like the interest payments you earn from assets you own, things like that. Then there's other ways you can spend money besides just consumption. They included like taxes on there.
Yep.
And then on the other side of the equation, money is not the only kind of savings you can have. You could also have savings in the form of like bills. So, this is government bills that you own. So we'd have to add this delta B here. Delta B, basically saying, on the left-hand, the left-hand side of the equation here is telling you like how much you save.
Mm-hmm.
And the right-hand side breaks it down to what form do those savings take. Some of it means you have more money. Some of it means you have more bills.
Okay.
And so on.
All right. So the top above changes is just what you've done this year. Consumption, the money that you've earned, the taxes you've spent, the taxes you've paid. So then you also have separate accounts aside from your money account. Those bonds, whatever, from this country and from the other two countries are earning interest. They're each separate accounts. So you have basically 4 separate accounts in this scenario. One of your savings and high-powered money, and 3 of the bonds for each of these 3 countries. And those,
I'd say really all 4 of them count as savings, right? It's just a question of what you can hold your savings in 4 different forms, right? You can have your savings in cash, or you can have your savings in bills. One for each government.
Okay, so account is the wrong term, but this is separating it into those 4 kinds of things. So this is just saying, however it's held, you have this amount of money, this amount of U.S. bonds, this amount of hash bonds, this amount of ampersand bonds.
Yeah, exactly.
Okay, that's clear. So the changes part is basically, so this is a transactions table, meaning a flow, and the changes is basically kind of the translation between the stock and the flow.
Exactly right.
Cool. All right. Good. Thank you. Thanks for walking
Yeah,
me through
you're
this.
welcome. So, you can do that again for each one of these columns. You'll notice in the firms column, because they were assuming no retained earnings, they have no assets. So there's nothing here, right?
Share again, please.
Oh, am I not? I thought I was.
Oh, no. Forgive me. I have to add it. You are.
Oh, okay.
Yep.
Cool. Yeah. So in the firm column here, they have no assets. And so there is nothing right there, right?
Understood.
And then in the government column, okay, the government spends money. They receive tax revenue. They pay interest on the bills that they have issued. And they receive the central bank's profits. And you can see the central bank profit comes from here.
Okay. No, it's an F, profit. F, okay.
Yeah, I don't know what that's about, but yeah. Central bank profits get paid by the central bank to the government.
Okay.
And then the government they issue bills, right? If they run a deficit, they would issue bills.
Okay.
In the Fed, the central bank, okay, so here is interest payments that the Fed is receiving. So this is in this entry here, we're looking at the government paying interest, and then that goes to, to everyone who owns those bills, which are like households in the different countries and stuff. And the Fed also has some government bills. They have some US government issued instruments, so they receive some interest. So that's that.
What's B Fed versus just B? B Fed $sign versus just B $sign?
I think the way the convention works is B means bills, and then there's two symbols or like two things after that. And I think the second one tells you who issued the bills. So like this one here, B pound $. The second one, the $, tells you that the US government issued this bill.
Yeah.
And then the first one is the holder. So here we're looking at
I'm asking about the B Fed $sign.
Yeah, so the $, the second $, means that the US government issued the instrument, and then the Fed means that the Fed is holding.
Oh, okay. All right, that's clear.
Yeah.
Okay.
So the Fed has so the instrument, the interest that they earn, they pay out their profits to the government. And then, they can issue cash, and they can also buy bills. Okay. And then a lot of it just repeats because we have households, firms, governments, and central bank in the other countries, right? So, here is households in the pound country, and they consume, they earn income, they pay taxes, they earn some interest. They earn interest on they can hold bills from each of the three countries, so they can earn interest from all those. And then here's the changes in the assets for these households. Same thing for firms in this country, right? They produce all the stuff, so they get, they receive the spending from consumption, government, exports. They have to spend to import, and now we're importing from two different countries, and exporting to two different countries. So that's what that's about. They pay the income to households in that country, and they hold no assets, so nothing here. And maybe I should, it really does just repeat, right? So here's the government.
I can see that.
Yeah. Okay. So I'll stop there on that. But
yeah,
maybe we should look at the ECB because I think that is a bit different.
So the ECB is both countries as a whole.
Yeah, exactly. And so they seem to pay their profits to both country governments. So here's minus F ECB. So this is the ECB paying its profits to the government in each country. And then, each of the governments issues bills and pays interest on them. And so the ECB receives some of that and also, I guess, receives interest. The ECB can hold bills issued by the US government and receive some interest on that. So that's this entry here. And then when the ECB issues money, that money can be held by households in either country. And so that's why there's two entries right there. And then they can hold the bills from any of the countries, right? So yeah.
Can you just repeat? You said that the ECB issues its bonds to both countries, or the profits to both countries?
Yeah, so it looks like in this row here, this is the central bank profit row. Here is the ECB paying out its profits, and that's getting received by the government in the at country
Got it.
and the government in the, so it gets split up, I guess, between these two governments.
Got it. All right.
I have no idea how that works in real life, to be honest. I assume that that is a thing, that the ECB pays out its profits to the Euro country governments, but I do not know how much or how that works. I don't know anything about that. So that's interesting.
Okay. All right, great.
Yeah, so that's the table. And so a lot of, many, but not all of the equations in the paper are based on the table that we just read.
Oh, all right. That kind of changes things because I really, the tables were thick. I kind of, I don't know if skip is the right word, but I was focusing just on these equations. Okay, so, I mean, the way that I said them, the way that I said them, I think was worked. So we have personal income for households in the U.S., which is equal to their income plus their bonds that the United States issued, plus the interest earned on them. Same with the country one, Euro country one. Same with Euro country two. And then there is the change in interest rate of the euro times both of their bonds, euro held bonds.
Okay, so you're definitely spot on with these first two parts. This third part is not quite right though. So you're not too far off, but
no, I'm laughing at how you frame you're wrong with you're right. Go ahead.
Oh, thanks. I was a tutor for a semester, so I did get a little official training on that. So right here, this change. So when you see R, like just an R by itself, that's an interest rate. But when you see XR,
exchange rate,
that's the exchange rate.
Yeah.
And
I thought well, that's what I meant with whatever I said. So the change in the exchange rate of the euro times the two bonds that they held, the 2 euro bonds that they held. And actually, and the S is the supply of bonds, D is the demand for bonds. So I don't understand. I don't understand how that works because the D bonds are what they actually hold. The exchange rate referring to the supply of bonds, I'm not sure how that fits in related to the their income.
Okay. So basically what it's saying is there's a third way you can be made wealthier, right? If you earn more income, okay, then you're wealthier. If you earn more interest, you would be made wealthier. But then there's this other thing that can happen that will also cause your wealth to go up.
Interest.
And it has to do with the change in the exchange rate, right? Which is like, if you hold a bond that's issued in a foreign country, so you hold, like, if maybe in your personal portfolio, Jeff, suppose you had some Japanese government bonds, and then the exchange rate moved in a favorable way, then the value of those bonds would go up.
I understand that.
Yeah, so that's what this is. This is a capital gain, an increase in the value of these bonds as a result of a change in the exchange rate.
Okay, I understand that. What I don't understand is the relationship between, on the end of 4, the bonds of the hashtag bonds in those parentheses related to the hashtag bonds in the middle of this equation. Are they the same bonds?
I think this is a part that I skimmed, and I believe that what you want is right. This information is right here. Subscript D denotes demand, in which case the bills are denominated in the currency of the country where the bills are held.
Yes.
But subscript S denotes supply, and the bills supplied are denominated in the currency of the country where the bill originates.
Oh, okay. So
yeah, go ahead.
Okay, so the bill, okay, all right. So the supply is they're the bonds from my country, but that seems to, I believe that that's correct, but it seems to conflict with the $ hashtag in the ones in the middle and on the end, which I thought was owned by United States citizen, issued by the hashtag. So that seems contradictory.
No, I think I think what you said was correct, but I don't see the contradiction. So here we're looking at, go ahead.
The demand is demand is the bills denominated in the currency of the country where the bills are held. They're held in the US.
Mm-hmm.
They're issued by hashtag, the
Mm-hmm.
hashtag country.
Yes.
The supply is, please scroll down like one line, denominated in the currency, denominated in the currency of the country where it originated, so of the issuer. So that implies that the bond, and where you're highlighting now, is just ignoring the subscript, is held by United States but issued by hashtag. But the supply seems to make that opposite, because it's saying it stands for the country where it was originated.
Yeah, so I think what this is saying is that you're right that these are the same bill. They're referring to the same bill or bond, whatever word you want to use. But in this case, what we're interested in is the interest income. And so when they write a D here, you just value this in dollars and then multiply it by the interest rate to figure out how much dollar interest they're going to earn.
Yes.
Whereas here, we're interested in the capital gain that happens because of the exchange rate. And so here, when we write it using an S, we're valuing it in euros now instead of dollars. And then the change in the value of the euro relative to the dollar causes you to, earn dollar wealth.
Okay. So the bonds, so we're referring to the same things here. These bonds are the same ones, and they're referring to the same things. They're pointing to the same things. So the D is simply, we're looking at these bonds owned by United States, issued by hashtag, but we're simply looking at the demand, which is the dollar sign version of dollar sign value of those bonds. And the S is simply, we're just looking at those same bonds from the other currency point of view. That's all it is.
Yeah.
Okay. All right. That makes sense.
Okay. Yeah. So these three equations, then you hit it on the head. There's your income from, producing stuff. There's your income from earning interest. And here's your income as a result of capital gains. Yep.
Got it.
Yeah. And that's just, there's one for each country.
Got it. All right. So then theta is the tax rate. So the percentage of your income equals your taxes. And then we can switch that around. So your disposable income is what's left over after you're taxed. So your income, I know that's what I wrote this down. I took a little brain busting to get that. So theta dollar sign times YP. No, wait a minute. Right, let me just think for a minute. So disposable income equals your tax rate times, so that's equivalent to YP minus theta YP. The 10 is equivalent to YP minus theta YP, at which, so your income minus whatever's tax taken out of that is what's left over is your disposable income.
Yeah, very good.
Thank you. All right, so your wealth is equal to your disposable income minus your consumption. So I have left over $10 after taxes. I spend 5 of them. My wealth is 5.
Well, not just your wealth, but your change in wealth, right?
My change in wealth is -5.
Go ahead.
My disposable income minus my consumption. So after taxes, I have 100 in income. I'm taxed 50. I have 50 left over. That's my disposable income. I spend 25. I have 25 left. So change in wealth, I'm not exactly sure of what period it's referring to. I guess just this year I spent 25 after taxes, so I have 25 left over, which means
your wealth goes up by 25 from whatever it was before.
This year. Okay. All right.
Yeah.
I got that.
There you go. Yeah.
And then same thing
they
for each
dropped a
country.
letter right there, a little typo, but yep.
Yes, missing the V. Yeah. Okay. So now we're into
All right.
alpha.
So do you know what a
I'm not
consumption
crazy.
function?
It's not explicitly stated here of what alpha means, but go ahead.
You're definitely right. They don't seem to say that. They just assume you've read their book, I guess. I don't know.
Okay.
Do you know what a consumption function is?
No, I don't.
Okay. That's all right. We'll get to that. What do you think about Greek letters? Like, what's your thought? Why might any guesses?
My thought about Greek letters.
Yeah, any guesses as to why that's there? What it could mean?
The amount of money that people want to spend, their propensity to consume.
Yeah, actually, it is their propensity to consume, and it's showing like if your disposable income was to go up by $1, then your consumption would go up by alpha 1.
So if they want to spend 25% of their income, then yeah, okay.
Yeah, that's right. So to take us a little step back, in the broader picture of these things, these models have 3 kinds of variables. So one of them is called endogenous variables. Endogenous means like determined inside the system.
Uh-huh.
And so whenever you see an equation that's got like a variable on the left-hand side, this is an endogenous variable. Like consumption, there's an equation in the model that tells you what consumption is going to be.
It's a formula. It requires a formula. Exogenous means that it's just a variable that we set before we run the model.
Yeah. So there's what I was going to go where I'm going though is there's actually 2 kinds of exogenous variables. They're both exogenous variables, exactly what you just said. There's no formula for them in the model. They come from outside the model. Mm-hmm. But there's sort of 2 kinds. One is like government spending, maybe. And government spending, I mean, it could be determined in the model, but I don't think they do in these models. It comes from outside the model. But it's not necessarily like fixed. It might change. Maybe we increase government spending in year 2 and then decrease it in year 5, or maybe we fit it to the data. Maybe we go look at the data from government spending and it's different every year and we use that as government spending, right?
The Greek letters are exogenous variables.
They are exogenous variables, but they're not like government spending, like I just said. So government spending, like I just said, sometimes actually gets called an exogenous variable. And this is about to get really confusing with the terminology. I'm sorry. So there's 2 kinds of exogenous variables, and only one of them gets called exogenous variable. So government spending, like if you're doing like I just said, you could get it from the data. It might be different every year, or maybe you make it up. You just make it up, and you're like, what if it increases in year 5, decreases in year 12? That gets called an exogenous variable. It can change and move around and stuff, but there's no formula for it inside the model. Mm-hmm. The other kind of exogenous variable that doesn't get called an exogenous variable, it gets called a parameter.
Yeah, this is evocative of that session that we had with the models. That just like you said, the capital C stuff on one side means that it comes from a formula. We can't know what it's going to be until the model is run. The Greek letters are the variables, which we might
parameters.
They're parameters. They're the variables. They're the things that we set before the model. We determine what we want them to be before we press go on that model. We might run it with a different variable, but all of these Greek letters, if I'm understanding, are different variables. They're different parameters for the model. So whatever they are, this one's consumption function, which is propensity to consume roughly. So this one is, I mean, that's there's more to learn, but that's a huge.
Yeah. You're absolutely right. And generally, I mean, you could change a parameter, as the model's going, but you don't have to, and it's not necessarily expected. Like this is probably just one number that's just fixed, right? And yes, this one here, alpha 1, is the propensity to consume out of income. So if your income goes up, how much is your consumption going to go up?
So alpha 1 just simply means there's a propensity to consume out of your income. There's a propensity to consume out of your wealth. They may be different.
That's right. So this one here, like you just said, is the propensity to consume out of wealth. If your wealth goes up by $1, how much does your consumption go up? Alpha 2 tells you that.
And -1 means your wealth at the beginning when before the model began.
It actually just means one period back in time. So as time keeps going, right, you're only looking, it's kind of like saying how much you spend right now is influenced by how much wealth you had like last month, maybe.
But it's not correct to say that that's when we press go, -1 expired at that point.
When you press go, -1 exists like before you press go, right? It's maybe like, so let's say if every single one of these variables, they're not really writing it, but every single one of them, you can think of there's like a little subscript T that tells you what time we're currently looking at.
Mm-hmm.
And so like, this could be like consumption in period 7 would be influenced by income in period 7 and also wealth from period 6.
Which, I mean, isn't that by definition, when I press go, we are no longer, that ends -1 period?
Yeah. I mean, all I'm trying to say is that it doesn't, like, if you can run the model for more than one period, and maybe they count up, so period 1, period 2, period 3, period 4.
Yeah. So, but each cycle. So when I press go, -1 ends, and when the next period starts, when the next year is run, then the next period. Yeah.
Okay. Yeah. You're
so
good
each
then.
iteration,
Yeah.
each iteration of the model increases that period, but it starts by -1, ends the moment that I press go. It turns into period 0 or whatever.
Yeah. So you're right. All I was trying to clarify was that this doesn't always refer back to period -1, because after you press go again, now it refers to period 0, and you press go again, it refers to period 1, right?
Understood. So each iteration, I got that.
Yeah. So wherever we are, subtract 1. But yes, you're exactly right.
Okay, good. This is incredibly helpful. I want to acknowledge we're at 50 minutes, so I don't want to keep you for too much longer.
No, dude, this is my profession. I mean, this is what I'm trying to go to school to do, is like have these kinds of things. So this is fun.
All right. I mean, it's enlightening. And okay, so propensity consume of income plus propensity consume times wealth. They may be different, but not dramatically different, and it really doesn't matter specifically what it is. It's just some decimal of your, and it could change based on your, obviously change based on your wealth. If you're really rich, you'll spend less and whatever. But okay, I think I understand that enough.
All right.
So 16. Okay, so now A3 is another propensity consume for something, which is equal to 1 over the wealth version times 1 over the wealth alpha 2, 1 over alpha 2 times 1 over alpha 2 minus alpha 1 over alpha 2.
All right, so I'm gonna
tell you very meaningful, but I got that.
Okay, I'm gonna tell you where this equation comes from, and it's gonna seem like it's magic because it is not in this paper, but it is in the Godly and the Law book. In that book they have a few pages on where this equation comes from and what it means and stuff, and I've read that. So I did not just magic this out of my ass or whatever. I've seen this equation before, and I get its deal, but they did not explain it here.
Okay.
What they do is you take this equation. And this is like one for each country, I guess, but you can take this equation and you can like manipulate it into an equation that looks like this. And what this equation is saying is that this is like, here, let me see. This over here, this over here is ends up being like a ratio of wealth to income. So this is your change in wealth, right? And when would your change in wealth be 0? Like when would delta V be 0? I know that's an oddball question, but run with me for a second. When would delta V be 0? Well, okay, alpha 2 is some number and alpha 3 is some number. And so delta V would only be 0 if this bit in here were 0. And this bit in here is only going to be 0 if V is equal to alpha 3 times YD.
Alpha 2 could also be 0.
Yeah, but it's not.
Okay, so we just know that it's not. So
Yeah.
therefore, inside has to be.
Yeah. So
Okay.
so delta V is 0 if V is equal to alpha 3 times YD. So the way you can think of that is your change in wealth is going to be 0 if your wealth is equal to this particular amount that is alpha 3 times your income. Okay, so when your
Okay.
wealth is equal to a particular multiple of your income, whatever alpha 3 times your income is, if your wealth is that level, then this is 0, so your change in wealth is 0, so your wealth doesn't change.
Okay, your propensity to consume is always a portion of your wealth or income. So how could that ever, a proportion of something is always something. So how could that be 0?
It's not that your consumption is 0. Your consumption is not going to be 0,
Okay.
but it's going to be equal to your disposable income so that your wealth doesn't change.
Equal to your okay. Okay.
Yeah. So when your wealth is this particular value here, here's your income, alpha 3 times your income is some multiple of your income.
Mm-hmm.
And when your wealth is equal to that number, so when your wealth is equal to alpha 3 times your income, then your change in wealth is going to be 0. What that means is you consume exactly your disposable income so that your wealth doesn't increase or decrease.
You consume exactly your disposable income, and which by definition seems to mean that your propensity to consume in this particular case is 1.
No, not necessarily, because there's 2 of them, right? There's alpha 1 and there's alpha 2. And so okay, we're saying that consumption has to equal your disposable income, right? But alpha 1 doesn't need to be 1 here because, alpha 1 can be less than 1, and whatever the gap here is between consumption and your disposable income will get made up for by this term.
Okay.
So let me jump to the punchline a little bit, because I think maybe that'll help.
Okay.
What this equation is telling you is that the households act as if they have some target level of wealth. There's here's how much wealth we'd like to have. It's a target. And if we have more than that, then we're going to increase our consumption spending to cause our wealth to fall. And if we have less than the target level of wealth, then we're going to try to cut our consumption spending to increase the wealth.
So we have a target wealth.
Yeah. And that target wealth is given by actually this bit right here, right? This is your target level of wealth. It's some multiple of your income.
Okay.
Yeah. And so like I said, you can get this equation from this equation. And I think the way that you do it is that you just set C equal to YD and then figure out what the change in wealth has to be. So just do a little bit of math on here to get from 16 to this one. And like I said, they don't do it in here, but they do it in the book.
Okay.
So does that kind of make sense? So what this is telling you is that if the consumption function looks like this, so consumption function just means an equation that tells you what consumption is.
Oh, okay.
And if your consumption function looks like this, then you can show mathematically that that implies that you have some target level of wealth. And which is given by, yeah,
okay.
Go ahead.
Oh, no. I'd answered the question is answered right in the first, right below that, which is just, it defines A3 equal to that formula.
Yeah.
That's where that comes from.
Yep. So A3 here tells you what your target level of wealth is, because it's whatever multiple of your income, that's your target level of wealth.
Okay.
And then A2 tells you the speed of adjustment. So you could say well, what if now the wealth is not equal to the target level? Okay, it might be too high or too low. Then depending on what the discrepancy is, right? This term here is going to be the discrepancy, right? So this here is your target level of wealth. This here is your actual level of wealth. And so the target minus the actual is like your discrepancy, how far away you are from the target.
Can you give me a simple number with the YD alpha 3? That is
Sure.
your
So
target level of wealth, but
yeah, sure.
your disposable income is a portion of your your disposable. Well, okay, basic question. What's the difference between wealth and disposable income? Because disposable income that's just defined above is simply your income minus your taxes. That is your disposable wealth. So after you have disposable income, so how is that different than wealth to begin with? Because that's all you have left in this scenario.
So your disposable income is just for one period, right? It's like your
Ah,
income minus your spending now, but your
okay,
wealth is like all the accumulation of the past. Here's, I've got my
got it.
whatever amount in my pension or whatever, your savings.
Which is
Yeah.
hence the -1 indicates that this is over, that it reflects over multiple periods. That is
Yeah, and
what
that
that
comes
is
from
what
up here. This is
Yeah,
saying that your consumption now is based partly on your wealth one period ago.
got it. Consumption of an American equals the propensity to consume over my current disposable income for this year, plus my propensity to consume over my total wealth accumulated up until last period.
Exactly.
Got it. And then down below is 16 is 16A is my wealth is equal to my propensity to consume of my wealth. That's the same alpha 2 is that is how much I want to spend out of my wealth. Inside there is uh, my disposable income times whatever value helps me get my wealth up or down to my target.
Yeah. So it's like, here's your target level of wealth, and here's your actual level of wealth. And so this whole expression in the parentheses is like how far away you are from your target, right? So like maybe if your income is $100, your disposable income is $100, and you would like to have 2 times your income saved. So maybe this alpha 3 here is a 2, and that's telling you your target level of wealth is $200, twice your income. And then this is your actual wealth. And maybe let's suppose that your actual wealth is only $150 right now. So you'd like to have $200, but you only have 150. And so this difference is going to be 50. It's how far away you are from your target. And then so what the rest of this equation tells you is that how much you're going to try to change your wealth right now is based on how far away you are from the target. So here's I'm $50 away from where I want to be, times this parameter that tells you like how fast you want to get there. So maybe this parameter is like, I want to get there right now. Like I'm $50 away and I need to get that $50 right now. So like if this were a 1, that would say you want to save however far you are away from the target, you want to get there right now. Or, right, this could be a lower number, and that could be like, I'm $50 away from my target right now, but maybe I want to get there over like 5 periods. So this could be like 1/5 right here. And so if I need to get $50 and I have 5 periods to do it, then this period I should try to get $10, and then $10 the next period, and then 5 periods from now I will have made up the $50 I need.
Okay, so alpha 3 is the formula to get from my disposable income to affect my wealth so that it gets to my target. But that is decided before the formula runs. That's just before the model is run. So
yeah,
how can that seems to be dependent on your wealth, on your disposable income and your wealth. So how is that something that would be input before the model even starts?
Basically what we're kind of saying is like, if we model consumption like this, that just kind of implies that people have a target level of saving that's some multiple of their income.
Oh, all right. I don't totally understand that, but that definitely helps. Okay.
It's like, you can think of it as like, this is our behavioral assumption. This is how we're going to assume that households behave. We're going to assume that what they do is they have some target level of saving. That target is just some multiple of their income. and they, try to save that much over some amount of time.
Okay. All right.
Which is not really that unrealistic. It's actually really not bad.
Okay.
The neoclassical critique is like, this is way too simple. People are, we got to take account of all the other things people do, and they learn and they optimize, and you can't, there's all this stuff about like rational expectations, and they form expectations about the future. And I feel like people do some of those things, but also a lot of people don't do any of that stuff. And a lot of people behave more like this, right? You like have some amount of money you'd like to have in the bank that's based on your income, and you try to save until you get there. And then if you have more than that, then you're like, shit, I got too much money. Maybe I'll go, buy a guitar or something.
Okay. All right. That's very helpful.
Yeah. All right. So that's what's going on there. This is tricky, isn't it?
I have no idea. So this means something else. It is a variable that we input. What does it mean? And where does it say what it means?
Which thing?
This Greek letter, the
okay.
first one in 19 on the right side.
This is the Greek letter mu, mu. That's how you spell that in English. Greek letter mu. And yes, these are all these mu's. These are different mu's you might notice. So this is like mu subscript $, pound, right? And this one over here is like mu subscript $, at. So these are all like different parameters. There's a whole bunch of them. And they are all parameters. They're outside, outside the model.
Understood.
And then what do they determine? So what is this?
Import of a U.S. import that comes from hashtag.
Yeah,
country.
Let's see. So I think $, pound.
The imports into U.S. from the hashtag Euro country, valued in the dollar.
Yeah, I think that's right. Okay, so this is telling us, hey, here's our equation that's going to tell us, let's see, imports into dollars. So here's our equation that's going to tell us how much the U.S. is importing from this country. So, businesses decide to import stuff from abroad. Here's how much. Here's how they decide.
Okay.
So this equation has 3 terms in it. And let's just look at the first one to start. So mu here is just some parameter. It's just a constant, right? It's just a number. Mm-hmm. And so this is telling us, like, if we forget about these other terms for just a second, like if only this first one were here, then this equation would be telling us that U.S. imports from the pound country are just this number, whatever that is.
Okay.
Yeah.
Understood.
So that's the first term in every one of these equations.
Does the zero? What does the zero stand for?
I think it's like this first term is mu0, and then in each one of these equations, the second one is mu1.
Okay, so the same thing like alpha 1, alpha 2. It's just they're the same concept, but they might be different values under different conditions.
Yeah. I think the alphas are like related to consumption, and then these mu's are like related to imports.
Okay.
Yeah. The alpha thing, I feel like alpha is pretty common to see in alpha right here. In a consumption function, you tend to see an alpha. I mean, not necessarily, but it's pretty common. Mu is just like, it's, whatever. They made this up. This is not like standard, I don't think.
But alpha does seem reasonable after what we've been talking about, that alpha is a propensity to consume. It's how much you want to consume, fraction that you want to consume out of your income.
I just mean the notation. Like, it could be a different letter, like you could see the same equation, but with a different Greek letter here, maybe the Greek letter beta.
Sure. But just in the context of what we've been talking about. Yeah. Okay.
Yeah. Okay. Okay. So the first term is just a constant, right? And it tells you, like, if nothing else mattered, then that's how much the U.S. would decide to import.
Okay.
Right. And same for all these other countries. This is how much the U.S. would import from the at country. This is how much, the pound country would import from the U.S. and so on, right?
And there's no thinking about what that number is. It's just some random, that's how much, we know that's how much they imported. They imported 12, whatever it is.
Yeah.
We don't need to know where that came from.
Maybe you'd find that from the data or something, or maybe you just make it up.
All right.
Depending on what you're trying to get the model to do.
That's what threw me. It's like, this has to mean something. What does it mean? And you're basically saying it means nothing. We just got it from somewhere. Someone told us.
Yeah. So then these other terms though, I think are a little bit more meaningful.
So
So
how many we purchased, how many imports we have, sales, domestic consumption and government expenditures, as well as import sales.
yeah, so yeah, I think if we jump down, there's actually an equation for it right here.
Okay.
So sales, consumption plus government plus exports.
Okay.
So, okay, so what this is telling us is that if sales go up, so if firms in the US sell more stuff,
Okay.
then how much is that going to increase imports? This is saying if sales go up by $1, then US imports from this country are going to go up by whatever this number is right here.
Sales of what?
$1 pound.
Sales of what? Sales in the United States to other United States. What is
I
that
think it's
sales?
just sales. I think it's just, well,
Oh, it's that. It's that.
yeah.
So it's consumption of the United States plus government spending plus exports. That's called
Yeah.
sales.
Yeah.
All right. Okay.
So it's saying if sales go up $1, then imports are going to go up by whatever this number right here is.
Okay. Okay. And then the exchange rate of the euro is just depending on the exchange rate of the euro, that will be multiplied by some other number. So if the exchange
Yeah.
rate goes up, it's just basically kind of a propensity to export or import. So if the exchange rate is this, I won't want to import more or less.
Yeah. So this is telling you like if the exchange rate, I guess it's saying if the exchange rate goes up, then there's a minus sign here. So imports are going to go down by this amount.
Okay. This is propensity to import. That's what this is.
Yeah, basically, yeah.
The first one that doesn't quite fit in, but
it's like a constant term, right? But yeah.
Okay. So the second, if I sell this much based on that definition, if I have this much in sales, then that's my fraction or whatever the number is. That's the fraction that I'm going to be that my desire for imports. And same with the exchange rate for euros, whatever it is, that's the proportion that I'm going to be calculating. Like if it's 2, then and the u is equal to, or mu is equal to 0.25, then I'm going to be importing 0.5. Just that's what I want to do. I'm just choosing to do that.
Sure. Yeah.
Okay. All right. Fair
and
enough.
So I think what this is trying to capture is like if firms sell more stuff, then one of the things that firms, so in this model, if we back up to the table, in this model, the only people that import anything are firms.
Import. Look at that. All right.
And so I think what that means is that firms are buying like inputs to production from other countries.
Okay. And it's immediately passed on to all those other things.
Yeah.
They don't hold on to anything, like we said.
Yeah, exactly.
Okay.
And so if firms sell more stuff, then they're going to also need to import more stuff because they're importing some raw materials.
Oh, interesting. Need. Okay. It's not totally arbitrary. It's I actually need to do this because I'm selling more things, and therefore that changes the situation. Things are more expensive, and therefore I can't afford to do so, so I'm going to be importing less, and so on. Okay.
Yeah, well, that one, it's a little tricky, right? It might, like, okay, so with the exchange rate, it could be an affordability thing. It's just we can't afford it. It could also just be like, if the exchange rate gets worse, then it's more expensive to buy stuff from abroad. We'd rather buy stuff locally.
Right. So, but the point is whatever it is, there's as you just said, there are real world conditions behind these numbers. So when the exchange rate goes up, my desire for importing goes down. When my sales go up, my desire for importing goes up. And then and actually the constant is, regardless conditions, that's how much I'm always going to import. Whether it is I have a minimal needs, or whether it is that's what I want to do. There are real world, each of these represent a real world condition, and actually I think that's bringing this to the real world is very helpful.
Yeah, there you go. Yeah, that's a good way to think about it. Definitely.
Okay.
So yeah,
All right.
there's one for each country. Now, one thing I will say that I think is very confusing in these equations is the way they've got the sign done for the exchange rate. So you'll notice in this equation, it's based on the exchange rate for the euro. But in this equation, these equations here, it's based on the exchange rate for the dollar. And the reason I think that's confusing is because, okay, think back to exchange rate economics here. When do you want to import more stuff? Is it when the exchange rate goes up or when the exchange rate goes down?
I want to import more when the exchange rate goes, when my money can buy more. So when my money appreciates, I can buy a lot more of the foreign currency. That is called the exchange rate going up from my point of view, I think.
Yes, you hit it on the head exactly. It was a slight trick question, which is when your currency strengthens, you can buy more of the other currency, so you want to import more, exactly what you just said. But is that the currency going up or down, right? From your point of view, that's the currency going up, but from the other people's point of view, that's their currency going down,
Yes.
right? Your currency strengthens is the same thing as their currency weakening.
Right.
Okay. Now here what they've got, I'm assuming here that mu is a positive number. And so this minus sign, it makes it negative.
Mm-hmm.
And so this is saying you want to import more if the exchange rate goes down, right? If XR is a lower number, then because this is negative, that's going to become bigger.
Mm-hmm.
And so this is the exchange rate, but from the other perspective.
Right. And
I don't know why they did that. This is saying
19 is importing to the United States.
Right.
And it's the euro exchange rate.
Yeah.
21 is importing into a euro country with the dollar exchange rate.
But I think if I'm not mistaken, it is the euro exchange rate, but from the other point of view. So what I read this equation as saying is if the euro gets if the euro gets weaker, then people in the US want to import more. Okay, the other way you could say that would be if the dollar gets stronger, then people in the US want to import more.
All right, I understand.
Those are the same thing.
I understand.
Right? If the dollar gets stronger, if the euro gets weaker, same thing.
Yeah.
And I'm not really quite sure why they've chosen to express it this way. If the euro gets weaker rather than if the dollar gets stronger. They're the same thing. Right?
Yeah. I don't see how 21 is different because it's just because it also changed the other side of the equation.
Yeah, so 21, we're looking at it from a euro country's point of view. And here it's saying the euro country is going to import more if the dollar gets weaker.
Right. And which seems to be it's the same thing proportionally.
Yeah, I mean, they could have written this as the euro country will import more if the euro gets stronger. But instead they've written it as if the dollar gets weaker, which is the same thing. You know, it's just from different point of views. And I'm not really sure why they chose to do it this way. It makes more sense to me to do it the other way, but it is ultimately the same thing.
Okay.
Yeah, that's it. That's all I'm trying to say.
Yeah, I mean, there's that's what makes this so difficult is not just what point of view are you looking at, but it's even what school of thought are you talking about. So it's and are you talking about real or are you talking about money, which is also there's a lot of
and then let me add one more for you here. There's this too.
Yeah. Okay. A log is like the inverse of like a no. I know it has something to do with an inverse of something.
Yeah, it's the inverse of the exponential. And you know,
square root. But that's
I'm assuming
not square root.
It's not square root. I'm assuming you don't want a big math lesson about natural logs right now. But
no, I know it's. I think I understand it. I just can't. I didn't memorize what it is. But it's basically
the short version is natural logs are closely related to like percentages. And so this is kind of trying to tell you that these are in percentages, not just like dollars. So what it's trying to say is like, rather than sales going up by $1, what if sales go up by 1%? Then your imports would go up by this many percent.
Okay.
Yeah, that's all. There's some math behind that, but you know, if you're willing to accept that, then that's what you need to know.
Okay, so it's not a constant number or an integer. It's percentage. I
Yeah.
mean,
Yeah.
okay,
Yeah.
that doesn't really change the core of anything that we said. Okay.
Yes. Yeah,
All
exactly.
right, good. All right, I got to ask you. This is really good. Would you be against me doing this, releasing this publicly?
I don't feel
Or
like
that
I've said anything really embarrassing in the last hour or whatever, so I'm okay if you want to release it. I will say that I'm not sure how interested anybody will be in this. I mean,
I
your
don't care.
podcast is for
I'm
activists,
interested.
right? Like this is,
Yeah, no,
you
I
know,
mean this.
I said
No,
this to Jonathan too when he and I were talking about the model that I came up with. I was like, yeah, I'll talk about math for a few hours, but I don't know who's going to listen to that. Like,
no, this is critically important to me, and I would hope that at least of some other people out there. This has been a really math has been a completely just a black monolith as far as I'm concerned, and this is like the beginning of the journey into that. And your talk with John, which I have not seen, but I understand what it was, and he that is the what we need as MMTers, as more advanced MMTers, to get into this stuff, especially that you're bridging your current paper bridges it into mainstream. I find that incredibly important. No, beginners are not going to be
all right,
watching
sure,
this,
yeah. I mean,
but
I'm happy to do it.
all right. Okay, I don't want to go too much farther. What I would like to do is, I mean, I feel like I've made a huge dent in this to a much deeper level. It's been,
Well, I'll tell you what. I think that there's only like one more page to this model, basically. I mean, okay, actually, there's a bit more. There's like how the like fiscal policy and stuff works. But once you've gotten to like about here, then you've gotten most of it. And so we
okay.
only have a few more equations left, and actually most of them are pretty simple.
Okay. All right. So what I don't think that this is particularly valid for as far as understanding this particular paper. I find this very valuable. Like our first interview with your paper, I use that as an excuse to ask very basic questions. And I see this as the same thing as far as math is concerned. This is very valuable for hand holding as far as getting into real math. I think that's valuable for that purpose. So,
Okay.
cool.
All right. So you got sales here, right?
Yes.
And then here, okay. You know what's
So
going on here?
exports. Let me
Yeah.
try
Okay.
exports of hashtag Euro country. No, from hashtag Euro country. Exports from the U.S. to hashtag Euro country equals the imports from hashtag to $ country times the exchange rate of from the dollar point of view. Oh my gosh. Okay. The exchange rate from the dollar point of view. So how do you even say that? The exchange rate from the dollar point of view. So $1 equals how many hashtag? How many euro? How many euro? $1 equals how many euro? That's the exchange rate from the $ point of view. That multiplied times the amount of imports from hashtag $2 to the US is equal to the exports from the US to hashtag Euro country.
All right, so I have not memorized the sign convention here, so I'm gonna have to scroll up and check it to see if you're right. So let's see. Imports here are imports into the dollar. Okay, so it's imports into whatever the first one is. So this is imports into the US. Okay.
From hashtag, yes.
Yeah.
And
And so
exports
this is gonna
from
be,
from the US to hashtag.
I think this is exports, yeah, exports to the US. No, wait, so this is,
No.
sorry, imports to the US from hashtag.
Yeah. The second
And
one,
this
the
is,
convention setup is that the second symbol is the origin, the issuer.
yeah, and so this is imports into the US, and so this is exports to the US.
How is that different?
They're not different, but it's telling you that these are measured in different currencies, right? This one is measured in dollars. This one is measured in euros. And so these two things are equal to each other once you factor in the exchange rate.
You are kidding me. So $$ hashtag is exactly the same thing as import $ hashtag.
Yeah, you can see it down here, this equation here. These two are the reason there's no exchange rate is because these are both the Euro countries, right? So this is, what is it? Imports into the hashtag. are equal to exports to the hashtag, right? And there's no exchange rate you have to deal with. So this is saying this is stuff that the hashtag country is buying from the ampersand country. And this is stuff that the ampersand country is selling to the hashtag country. It's the same thing, just from two different points of view, right? From one point of view, they're imports. From the other, they're exports. So
Oh my
that's all
gosh.
this is. It's just an identity. And here, because they're valued in the same currency, that's it. But then here, in the US, we look at it, we're measuring it in dollars. But in the hashtag country, they're measuring it in euros. So you need this exchange rate.
Ooh, all right. So 31, I am importing from ampersand to the hashtag country. On the left side, I am exporting from the ampersand to the hashtag country. But the difference is that from the point of view, what does it even mean to say from the point of view? That it's priced in? That it's priced in the, on one side it's priced in the ampersand, on one side it's priced in the hashtag?
Well, here, because they both use the same currency, they both use the euro, right? They're just
Yeah.
identical.
Okay, I understand that. Pretending that they're not, is one side priced in the other currency?
I'd say it's more like in this, go back to 28. Here, when we talk about imports and we're the US, so this is like US people are measuring this number, right? And they would measure it using dollars. So this is the dollar value of the US imports.
Dollar value. Okay.
And here, this is the other country measuring the stuff that they sell to the US. And
Other
so
country. Oh, okay. So the imports is the US saying how many hashtag products have been imported into my country, obviously filtered through an exchange rate. The exporting is speaking from the other country. So the hashtag country has, I, the hashtag country, have imported that much to the United States. So it's speaking about the
exported,
same,
right?
it's speaking about the same transaction from the other party's point of view, from actually standing in that other country. That's their view of the same transaction. And
Exactly.
the exchange rate on 31 is simply 1.
Exactly.
Whoa. Okay. Okay.
Yeah. So these equations are all pretty straightforward.
Yeah. After you yeah, okay.
Okay. And then here, how about these?
Exports from, no, exports is from the United States point of view. So the United States exported however much, and the total of their exports is the exports to the hashtag country plus the exports to the ampersand country. Okay. 35 is the same thing. 36 is the same thing. And then the same thing just from the same transaction so the things were imported from, things were imported from the United States. So I'm standing in hashtag whatever. I'm standing not in the United States.
So
And I'm
here
saying,
you are standing in the United States in 37.
okay.
And yeah. So this here is total US imports. And we're saying it came from, some of it, US imported some stuff from the hashtag country. And the US imported some stuff from the ampersand country.
All right. I understand that. I'm confused
That's it.
with above, it was from a different point of view. Like it switched points
Oh,
of
okay.
view.
Yeah, so in these equations, you notice we have exports on one side and imports on the other in each equation.
And there's two signs. There's two country symbols.
Yeah. Here, like this first equation is only exports. Here, if you'll notice here, it says exports and imports by each country aggregated. So this is just saying like the US exports, actually let's do it with imports. I think it's simpler with the imports. The US imports, we're counting now all of the imports. That's going to include some of the imports from, or it's going to include the imports from the hashtag country, and the imports from the ampersand country. So this is saying the US bought stuff from abroad, and they bought it from two different places.
Got it. I understand that.
Yep, that's it.
So, okay, the switching of the point of view, like, how do you know? I guess the context just tells you that this import of IM dollar sign means that I'm standing in the United States and talking about imports into me, as opposed to up above in like, okay, so that it has
I think the sign convention they use is that the symbols, like, let me see if I can explain this right. The first symbol is, both the symbols track the materials. So like think of it as the physical goods. And so if you see $hashtag, that means goods, the physical goods moved from hashtag to the $.
Yes.
And when the US is thinking about that, because they moved into the US, it's an import.
Okay.
But if the hashtag country is thinking about goods that move from the from their country to the US, for them it's an export.
X $hashtag means that I am in the hashtag country and I send stuff to the United States. I am $hashtag means that so the two country symbols always goes from right to left. Always goes from right to left. So an export means that I'm standing in the left country, and import two signs means that I'm standing in the right country, because that's the source country, the issuing country.
I think the first part is right about the movement of the goods goes from right to left, but then I think you said the second part backwards.
Import country. Yeah, of course. The destination it's always left. It's always right to left. So import means that I'm standing in the destination, which is the left. So the export means that I'm standing in the source, which is the right.
There you go.
Got it. Okay. And then down below there is no two there. So the fact that it only has one means that I'm only talking about that I'm standing in the United States, and some of those imports came from hashtag, some came from ampersand, and the right side of that still complies to that. Import is I'm in the destination. It's always right to left with those two symbols, just in this particular paper. So, okay, now I understand. Thank you.
Yeah. And yeah, like you just mentioned, by the way, this particular paper, this is not standard, and they explain somewhere in the paper that they're doing it this way. And in a different paper, it might be done a different way. So
and you're
don't
just
get too attached to it.
Right. You're just talking about the two country symbols in this case.
Yeah.
Which is a very, very simplified. There's only two countries in the euro, and the only other country is the United States.
Yeah.
Okay. Yeah, I got it.
Yeah. All right. There you go. So that's those equations. Now here, this is going to be the fun part. So we've got these four equations right here, the 49A through 42. And then
is that sigma?
No, it's not. But that's not a bad guess.
Beta?
Sigma looks a little bit like this. It's a lambda.
All right.
Lambda.
Okay.
So we've got those four equations, 49A to 50 to
lambda.
This is weird. Okay, 49A to 42. I don't know why it's numbered that way.
Yeah, that's a mistake. That's just a mistake.
I don't think it's a mistake. I think they come back to these equations later. But so then we've got this other set of four here, 50A, but 43 to 45, and then 51A, 46 to 48.
Oh, okay.
So all I'm trying to say is we have three sets of four, and they're gonna correspond. There's one set for each country, right? The first four are for the dollar country. The second four are for the hashtag country, and the third four are for the ampersand country.
Okay.
And so there's a lot of numbers here. There's like lambda 00 pound, lambda 01 pound dollar, lambda 01 pound dollar, and so on. There's like a lot of numbers here.
So 0 is just the first line, 1 is the second line, 2 is the third line, third is the third line. So the second digit has something to do with the second digit is just simply, in this context, is a constant. The first one is a constant. So in the same kind of thing, like when I import, I always import something, a small amount of something, regardless of what's going on in the world. So whatever this is I'm always doing something, regardless of what's going on in the world.
Yeah.
And again, the two country signs is the same thing. It's going from right to left, the destination, the issuer's on the right, the destination's on the left. So that's part of it.
Yeah, you nail all that stuff. So definitely these are constants, like you just said, like the first term is a constant. And then the first digit here does seem to be the row number. So all the ones in the first one are 0. All the ones in the second one are 1, 2 in the third line, 3 in the fourth line, right? Row numbers. And then the second digit is a column number, right? So you can see in the first column, they all have a 0 in the second digit.
No different than just the sigma 1 and sigma 2, just that's the second spot where they're shown.
Yeah, exactly. And here we've got 4 columns. So there it goes from 0, 1, 2, 3. So that's a total of 16 numbers in 4 equations.
And there's nothing special about them. It's just simply this is the fourth one. The fact that they have 2 digits, I mean, whatever. It's just the 0, 0 is just the first on the first row, and so on. So there's really nothing special about the particular numbers themselves.
Yeah, it's just exactly right. It's just so they can identify which number, because in these 4 equations we end up with these 16 parameters, 16 lambdas.
So to reference them later with ease.
Exactly. Yeah. So they can tell you like, hey, lambda 2, 2 is this or that, and lambda 1, 1 is this or that. So they can tell you which one of these numbers they want to be talking about at any moment.
Okay. So 50 is H. H is high-powered money. So okay, so H is just the D is priced from, well, and there's only one thing here. So what else would it be priced from?
Oh, the D is demand, right?
Demand. Oh, the demand for hashtag money over the wealth of the households in that nation equals some constant minus the interest rate of the United States minus the interest rate of Euro 1 minus the interest rate of, well, the constant times the interest rate of Euro 1 and minus some other constant times the interest rate of Euro 2. So for hashtag residents, the array of asset demand. So just the variety of things that they want to buy. I'll just leave it there.
Yeah, that was all great. That was all great, Jeff. That's exactly right. I mean, so this first equation, you're right, it's money and it's demand. This is the demand for money, right?
Demand for money. Okay.
And specifically, the way they've expressed it is this is the ratio of money to wealth. So this is like, of all of your savings, of all of your wealth, how much of it do you want to hold in the form of money? That's what this equation is going to tell you.
Say that again. So just say that again, please.
Yeah, out of all of your savings, all of your wealth, how much of it are you trying to hold in the form of money?
Meaning, how much do I want to spend? The rest of it is
well, not necessarily spend. No, just hold as an asset, right? It's just like, I don't know what your financial situation is, Jeff, but let's suppose that you have $50,000 to your name, and some of it is in the form of cash in your bank. Some of it is in the form of like bonds that you own or stocks that you own or whatever, right? And so this is like, of that $50,000, how much of it do you want to have it in cash? Maybe you would like 25% of it to be in cash.
Okay.
And so this would be like 1/4.
Okay. Understood. So demand for cash is just a reflection of savings, but in this article, or this is context of imports and exports, how they relate to each other. So the interest rate in these other countries, I mean, you have a savings for a reason. You have savings for a future, protecting yourself against something, or for a future, I want to buy things from these countries. So there has to be some sort of reason. I'm not saying that you even have to say, but.
Yeah, I mean, certainly there is. The reason is not really modeled in the model, but what they do, and this is what we were talking about before, is that if you do the consumption function like this, then
target
that implies this equation, that there's a target level of savings. And so they don't go into, you could have a model where you're like, hey, the world looks like this, like it's uncertain and you got bills to pay and your kids got to go to college, and therefore that's going to cause you to want to save, a certain amount of money. They don't do that in this model. They just kind of assume, by virtue of having a consumption function that looks like this, that just is the same thing as assuming that people have some target level of saving that they'd like to have.
Okay. All right. Fair enough. So back down to where we were.
I guess yeah. I mean, it's the same.
It's all the same stuff. Yeah. So it's just simply saying, I want to have, based on the conditions of the world, this is how much I want to save. This is how much cash I want to have on hand for whatever reason, whether it's because I might want to buy something later. I might, I might want to import stuff later based on interest rates or whatever it is. There's some reason for them to want to, there's some real world condition for them to want to have that particular amount of cash at this time.
Exactly.
And those are some of the factors for informing that.
So here is like all of your wealth, right? Like your overall, your portfolio, you could call it, is V. And then H over V is just like the fraction of your portfolio that's in money.
Yes.
And then here.
Money meaning actual cash. Yes. Liquid.
Yes, cash. Yep. Yes. Here, this is like the fraction of your portfolio that's in bills that are issued by the hashtag government.
And held by those people in that same country.
Yep. And here we're looking at, I guess we're looking at the hashtag residence right now. So here, this equation is telling you the fraction of their wealth that the hashtag residents would like to keep in the form of bills issued by the US government.
Bills issued by the US government. Okay, so 44 is, I'm a resident of hashtag. I have this much wealth in hashtag or euros, but whatever.
Just total
wealth in euros.
Yeah, I guess it would be measured in euros. Yeah.
So this is how much wealth I have in euros, and that and the top is how much of that I want to how much I want to hold in dollars, money. Okay. It's how much I want to hold in dollars, but I don't see what that has to do with. So it's just simply dollars being held by hashtag residents. It's still dollars, but it's just going to be held in the hashtag country by a citizen in the hashtag country.
Yeah, to be a little more specific, it's bills issued by the U.S. government, right? That's what the B here is, bills, right?
Bills issued by the U.S. government, but sent to someone or received by someone in the hashtag country.
Yeah, so this is like somebody in the hashtag country has saved some income and they're deciding what form they would like to keep their savings in, and they would like to keep some of it in the form of bills that the US government issues. It's kind of like if you, Jeff, decided, I've got some savings and I'd like to keep some of it in the form of Japanese government bonds. It's like that.
I'm opening a bank account in Japan. That's what that is. They can't send, I can hold physical bills if they mail them to me, but that means that I'm holding an account in Japan.
Yeah.
As a US resident. It's not I'm holding Japanese yen in my American bank account. That doesn't make sense. So I'm claiming
in the US banks aren't really allowed to do that, but in other countries they are. But this model doesn't have banks at all.
But just conceptually.
Yeah.
So in this simplistic model, I am actually receiving US dollars as a hashtag resident and holding US dollars.
I think like kind of either way you want to think of it, if you want to think of this all as paper, like this is paper money here, H, and these are like bills, they used to print out the bill on a piece of paper that says like, I've got the government owes me, yada, yada, right? So if you want, you could think of it as paper bills. You could also think of it as accounts. The central bank is keeping track that somebody owns a government bond in a different country, or maybe there's also like some brokers in between, like the do securities clearing and things like, kind of weird things like that. Either way you want to think of it, you could think of it as an account, or you could think of it as a piece of paper. But either way, the U.S. government issued an IOU. That's what this $ sign here means. And it's being held by somebody in the hashtag country. Okay. And yeah, so this is what fraction of that wealth, the household wealth in that country, gets held in the form of IOUs issued by the U.S. government.
Okay, so however it is, I, as a hashtag resident, own dollars. Whether I'm actually holding them in my account or I have an account in the U.S., whatever it is, I have ownership over some amount of dollars, or want ownership over some amount of dollars, or dollar sign or dollar assets in some
dollar assets. Yeah.
Okay. All right.
That's it. And then this last one here is same thing, but for the other Euro country, right? So this is like you're a hashtag country resident. Here's some amount of wealth that you've got, and then what fraction of that wealth do you want to hold in the form of assets issued by the other Euro country government?
Which is a euro. So what is the 45 and 43 are redundant. So what is
They're
the
not
point of
redundant. So
having?
these are bonds issued by the hashtag government.
Oh, bonds.
Or bills, bonds, whatever you want to call it. And these are bills, bonds, whatever, issued by the ampersand government.
These are not euro. I mean, they are euro bonds, but they're created
So if
by
you want to think maybe let's just say the hashtag government is like France and the ampersand government is like Greece, right? So maybe you live in France and you can own some French government bonds. You could also own some Greek government bonds.
Okay, so these are currency user bonds. These are basically just like company shares. So they're company, maybe shares is the wrong term, but company created stuff that are not backed by the central bank.
Well, they're government bonds, and just depending on what the ECB's policy. Like, okay, this one here, right? This is like you live in France, and some of your wealth is in the form of U.S. government bonds.
Understood.
Yeah, so that's what this one is. This is like you live in France, and some of your wealth is in the form of French government bonds. And
how is a French government bond different than how is a hashtag government bond different than an ampersand government bond?
They're different governments, right?
But they have the same central bank. So how are they different?
Well, if the Greek government decides to default on their bonds, and so these just become worthless, maybe, that might not happen at the same time to the French government.
Okay, all right, that's all right. That's far enough of that. I understand.
Yeah. Okay. So these are asset demands, right? So this is like I live in the hashtag country. Maybe that's France. I live in France, and I want to keep some of my wealth in the form of money, some of it in the form of French government bonds, some of it in the form of U.S. government bonds, some of it in the form of Greek government bonds. Right.
Okay.
And so each one of these equations tells you what fraction of your wealth you're going to keep in those different forms.
Okay.
Okay. So that implies something about these various coefficients here. And let me just
coefficient. Coefficient is just something that's
yeah, sorry.
Yeah. Define coefficient, please.
Sure. So coefficient just means like when you multiply something. So by coefficients, I'm talking about these lambdas, right? And it just means like a coefficient is when you multiply a number by something
So
else
a product is made up of two coefficients?
You could say that, but more typically it's like, here's a term in the equation, and this term, this R $ here is like the more important thing, and this lambda is the coefficient that multiplies by the R $. So
it's the exogenous.
Yeah, it's the parameter. You can use the word parameter or coefficient like a little bit interchangeably.
Okay.
So this is saying like, if the interest rate in the U.S. goes up, how much is that going to affect somebody in France's desire to hold money?
Mm-hmm.
This number, this parameter, or this coefficient tells you how much.
Okay. I understand that.
So you can see like in this column here, this is all the interest rate in the U.S. This is all the interest rate in, I guess I'm calling it France now. And this is all the interest rate in Greece in this column, right? Greece, France. And so then these parameters, or call them coefficients, kind of same thing here, just tells you this one, like all of these are going to tell you how much if the interest rate in the US changes, how much is that going to affect these demands for these different assets?
Okay.
That's given by these coefficients here.
Got it.
If the interest rate in France changes, how much is that going to affect these asset demands? That's given by these coefficients right in this column.
And
if the interest rate in Greece changes, how much is that going to affect all these asset demands? That's given by this parameter, these parameters in this column.
just by nature of Greece being less powerful than France being less powerful than the US, the numbers are going to reflect I'm going to want more of the US. I'm going to want a little bit less of France. I'm going to want less of Greece. So those coefficients will, decrease just by nature of the real world state of these countries. as
You
far as.
definitely could put that into your model if that's what you're trying to model. Yeah, you could do
But
that
I'm
for
but I'm
sure.
saying the coefficients. I'm reflecting what those coefficients actually will be valued as. If it is Greece, then I'm going to want less of Greece bonds just by nature of their not as a powerful position as France. So that coefficient O2 is going to be a little bit higher than Greece, and the United States is more powerful, so my wealth will be more secure. So that
Mhm.
coefficient for that one is going to be higher. That's I think a reasonable real world kind of interpretation of what those
Yeah,
numbers.
you could say that. I mean, what you're doing, I guess I'd say you're getting a little ahead of where we are here, because at this stage where we're looking at equations and stuff, we haven't stipulated anything about what these parameters are yet. And you're kind of, so you're jumping to like, well, what are these parameters? What are the real world constraints on them? And we got to think about this, what kind of factors should we be thinking about to determine what they are? So yes, you can definitely do what you're doing. You're stepping a little bit ahead of where we are at this moment in this paper, but for sure you're thinking on the right lines.
All right, good enough.
Okay, so now you might notice something here, that if we were to take all four of these equations and just add them up. So we take like these four equations, we take what's on the left side of each one, this H over V, this B hashtag over V, and so on. We take all four of those and we add them up together.
And then it would be 4V on the bottom. So that plus that
No,
plus
no,
that.
no, that's not how fractions work. You don't add the 4V, right? It's like,
Oh,
yeah.
no, they're common denominators. Yes, we're not
Yeah,
multiplying.
yeah, there you go.
So we're we're adding the common denominator. So it's simply that plus that plus that over V. Hashtag.
Yeah. Okay. Do
It's
you?
not how fractions work.
That's okay. Okay, so here's a question, and I will be a little impressed if you get this, so don't feel bad if you don't. But that's going to add up to a specific number. Can you figure out what that number is and why?
Give me a specific number. We're not talking about any specific. So okay, so add up to a specific number and why. Well, this is the whole world. It's going to add up to 1.
It is going to add up to 1. Yeah, it's very good. Although it's not, because it's the whole world. So if you took this H over V and you added up this B over V plus, this other B over V plus this other B over V,
That's
that is going to add
100%.
up to 1.
Because the top adds up to 1 and the bottom is equal to the value of the hashtag. In the context of the hashtag, that is the total wealth of the hashtag country. And so the top has to, I just instinctually, I don't really have this, but instinctually the top has to add up to 1 because that's the total amount of stuff from the rest of the world.
Well, the top doesn't add to 1. The top is going to be H plus B plus this other B plus this other B, right? And the top is, when you add those up, what you would find is that those are actually equal to V.
I mean, 100%. Yeah, 1 is 100%. Yes.
Yeah, because it's like,
they could have $50 in there, but the top is going to add up to 50 over 50. That's 100% of the wealth in that nation.
Yeah, there you go. That's exactly it. Is V is the wealth, is all the wealth that the households in this country have, and these four things, this H and these three B's, are the four different forms that you can have your wealth in this model.
Understood.
So if you add them all up, you get the total of all the wealth.
Money from my country, and then bonds from all 3 countries.
Mm-hmm.
Over the total wealth of my country, which is obviously equal. So 50 total wealth is made up of 5 money plus 20 hashtag bonds plus 30, whatever. I lost the number already, but adding up to 50 on top.
There you go. That's exactly right.
Got it.
So these 4 numbers, they have to add to 50. Okay. And so then, that was very good, by the way. So then on the other side here, so then we can think about what that does for these numbers. And we tend to define these lambdas, these coefficients or these parameters. What we'll usually do is define them in a particular way, and that goes like this. So first of all, just for a second here, kind of ignore all of these and only imagine we only have the first one.
Okay.
So in each of these equations, it's like I'm deleting all of this term and I'm only keeping the first number.
So I want to have a certain amount of cash on the top line. I want to have a certain amount of cash regardless.
Yeah.
I want to have a certain amount of hashtag bonds regardless.
Yeah.
And this is exactly this is not a fraction or a fraction. this is not a decimal. Or, I mean, I guess it could be. Might want to hold $0.25, but that's kind of silly.
Well,
So I would think that that would be an integer. The constant would be an integer, just kind of
well, actually,
logically.
no, it should be a fraction or a decimal because, like, okay, so again, delete all this other stuff, right? And just keep, we've got h over v equals this first lambda, right?
Yes.
So h over v is the fraction of your wealth that you would like to have in cash. So maybe this is like 1/10. You want 1/10 of your wealth in cash.
Yes.
So then this lambda 0 would just be 1/10.
0.1. Okay.
Yeah.
Okay. Okay.
Okay.
All right. Yeah.
So
it's the proportion. It's the
yeah.
proportion. It's not how much. It's the proportion.
Yeah, exactly. Proportion. Yeah. Very good.
Yeah.
And so what we typically do is just like kind of delete all the rest of this. And so for each one of these equations, we imagine we start out with just this. This on the left side equals just one number here on the right.
Mm-hmm.
And so what we'll say is, well, we said that all the stuff on the, if we take the left side of all four of these equations, that has to add to 1.
Mm-hmm.
We're going to make that true for these first numbers here too. If we took this first number plus, this first number, okay, plus this one,
because they can only have their wealth adds up. Only can have 100% of their wealth. So if they have 50%, if they have 10% in cash, then obviously there's only 90 left over. So those have to add. That has to add to 100%.
Yeah.
Yeah. 100%.
Yeah.
Has to add to 1. Has to add to 1.
Exactly. So on the left side, they have to add to 1. And what we'll do is we'll say, well, for the first number, we're going to say these also have to add to 1.
On the assumption that all the rest is gone.
Yeah, exactly. We're going to say this should still work, even if we delete all the rest of this.
Mm-hmm.
And so these first numbers are also going to have to add to 1.
Got it.
And so what you can think of like this equation by itself is like, if nothing else mattered, if these interest rates over here, if those didn't matter at all, mm-hmm. then this is how much of your wealth you would hold in cash, right? This is how much of your wealth you would hold in bills from the French government or whatever, yes. If the rest of this stuff didn't matter. And yes. So those have to add to 1.
Got it.
And then
it has to add to 1 on the assumption those other things are gone, or even so?
On the assumption that those other things aren't there.
The three right-hand terms are gone, then it has to add to 1. I understand that.
So we're going to say like these first column is like how much of your money you would want, or sorry, how much of your wealth you would want as money if this other stuff didn't matter.
Got it.
That's basically how you can think of this term. How much of your wealth you would want as money if these other things didn't matter.
If I don't care about interest rates at all.
Yeah.
So interest rates don't matter. Those final 3 terms. So actually it's just the 01, 02, 03. All the 1s, 2s, and 3s at the second digits are all 0 in this case.
Yeah. So if you imagine that, we still want this whole thing to work, and so we're going to have to say the 0, 0, 1, 0, 2, 0, 3, 0. Those add up to 1, and yes. We're going to keep that. That's going to be a rule. We're just going to set it.
And so this rule is again this rule. All of the interest rate terms are gone, and this rule is that these add up to 0. They add up to 1.
Add up to 1. But we're also going to keep that rule even when we bring back the other terms in a moment.
Okay.
Yeah. So first rule, the first column adds to 1. Okay. Now what I'm going to do is I'm going to bring back the other terms. Okay. And let me see. I think the way to do this is probably to bring them back one column at a time. So let's suppose now that the dollar interest rate matters. Okay. And here's how it's going to matter, and you can see it based on the pluses and minus signs. So if the dollar interest rate goes up,
mm-hmm.
If the dollar interest rate goes up, then you want more U.S. government bonds because they pay more interest.
Yes. So my power thing was not considering signs. My discussion of Greece being less powerful, whatever. I wasn't even looking at the signs. So yes. Okay.
Yeah. So with the sign, if the dollar interest rate goes up, you want more U.S. government bonds, and so there's a plus sign right here in this U.S. government equation.
Oh, and then so the 2 is negative because that takes away from my desire for $ bonds, for U.S. bonds.
Yeah,
because that means
exactly.
I'm going to want less U.S. bonds because hashtag has a better interest rate. So
exactly.
it's not referring to we're not talking about the hashtag bonds. We're just talking about my desire for, in this particular equation, my desire for US bonds. So my desire for US bonds, if euro interest rates go up, my dollar sign desire is going to go down.
Exactly.
Got
And
it.
same thing with this last term here, right? This is.
Oh, and cash is less effective or
Now for
whatever.
cash, so
Differently
okay, so
effective.
actually wait, we just did the dollar sign ones. Now let's maybe go this line here. So you'll notice
Plus
there's
for
one plus
hashtag,
sign
minus for the
here.
other two.
Yeah, there's a plus sign here. If the French, I'm guessing this is still France, I guess. If the French interest rate goes up, then you want more French government bonds,
Yes.
but you want less US government bonds,
Right.
right? I'm sorry, if the US interest rate goes up, then you want less French government bonds.
Yes. And same with Greece. Yes.
Yeah, if the Greek interest rates goes up, then you want less French government bonds.
Right. And just to bring in like the power thing again, that might be that coefficient could change. Like that number might be not as big because I don't value Greece, even if their interest rate is high. I might not value that as much.
Yeah,
So
that's right.
yeah, okay. All right. I get this. So
And then, yep, go ahead.
So 43 is my desire for France bonds. Hashtag is France. My desire for France bonds goes down when the interest rate in the US goes up, because obviously I'm going to want them more. But this row doesn't say how much. It's just going to show my desire for French ones go down. And same with Greece. When the interest rate in Greece goes up, my desire for French bonds goes down. And it's the same thing. It's exactly the same thing for the other two. It's just where the minus is.
Exactly. And then you'll notice, so that's exactly right. So in the French equation, there's your plus sign. It's on the France interest rate.
Sure.
In the US, the plus sign's on the US interest rate. And for Greek government bonds, it's on the plus sign is on the Greek.
And on the cash
rate.
one, I want less cash if I can earn a lot more on bonds, and which is the idea of interest rates don't affect my investing or buying. It affects my, or no, it's something like the interest rate affects my composition of what form my money will be in, as opposed to, I forget what the alternative is, the neoclassical version of that.
Yeah, that's exactly right, Jeff. So when any of these interest rates go up, the demand for cash goes down, right? You've got 3 lines here. If any of these interest rates go up, you're going to want less cash.
Yes.
You're going to shift the composition of your portfolio from cash to bonds because interest rates are higher.
Yep.
Yeah. There's one more thing to take a look at here. So we're almost done with this topic, which is a big topic, but you'll notice it bought us 12 equations, right? Because we have 4, one set in each country. So that's pretty good. But okay, so the one last thing I want to look at is by the column. Okay, so we said that the first column adds to 1, right?
Yes.
The other columns don't add to 1. Do you have any guess what they might add to? The other columns do add to something. Each column adds to something, but it's a different number.
Okay, and you're talking about not just the coefficient, but the multiplication.
No, just the parameters, the lambdas.
Just the parameters.
Yeah.
Well, I'm going to hold cash plus bond plus bond plus bond. That's the universe of what I can possibly hold. So I only have so much wealth, so I can only buy so much of each thing. So the universe of bonds, I'm going to guess that has to add up to 1 as well. Well, but the minus changes that. So the plus, is 2-1 a positive number and 3-1 is negative and 1-1 is negative and 0-1 is negative?
I think the lambdas by themselves are all positive. So then after you do the minus sign, it becomes negative.
So in that case, just the coefficients themselves, I'm going to have to guess, are going to add up also to 1, because we're still talking about the universe of possibilities within, just considering the interest rates of dollar sign will influence my desire for cash, US bonds, France bonds, Greece bonds. So I'm going to say it's adding up to 1.
Okay, so that's not right, but good try though. So what happens is, remember, on the left side of this equation, they all have to add to 1 because this is like it's your overall portfolio, like 100% of your portfolio, right? Mm-hmm. And then we said that we're going to say that these first terms already add to 1.
Okay.
Okay. And so if like the US interest rate changes, like maybe this R dollar sign goes up, let's say. So we said that you're gonna want more more US government bonds and less of the other bonds, right? Less Greek, less French bonds, or whatever else we said, right?
And less French cash.
And less French cash. But these four numbers on the left side still have to add up to 1. And
so the equals to 1 add up to 1, so that equals, so those have to be less than 1. It has to add up to 0.
Exactly, it has to add up to 0, right? If this one goes up, then
so they're
the
negative
other
numbers.
three,
I wasn't thinking of negative numbers. Yeah, okay.
Yeah, if this one goes up, then the other 3 have to go down by the same amount in total, so that these 4 numbers still add up to 1.
Got it. So we're not talking about the plus and minuses here. We're talking about the coefficients themselves being summing up to 0. So the coefficients themselves may be negative, which are going to then be affected by the negatives or positive addition, the addition and negative minus signs.
I could be wrong about this. I want to say that these are all positive numbers, but then after you factor in the plus, the minus sign, they can become negative. And when I say add them up, I'm actually talking about including the plus or the minus sign. So like,
okay, I was only talking about the coefficient. I was only thinking of the coefficient.
Yeah, sorry about that. So I'm pretty sure the way it goes is that lambda 2, 1, minus lambda 0, 1, minus lambda 1, 1, minus lambda 3, 1, that has to equal 0.
Okay, then the question, I don't even think it makes sense to say what do the coefficients
okay, sorry about
by
that.
themselves. I believe that's correct, that what those coefficients add up to could be anything.
I was mostly just reading it from right here.
Oh, there you go.
Yeah. So okay, so sorry about that. But the important thing is that the columns of the table add to 0 because this column has to add to 1. These columns already add to 1. And so after you factor this in, right, if the dollar interest rate changes, right, one of these is going to get bigger, the others have to get smaller, but it has to happen in such a way that they still add to 1 at the end, which means the columns have to add to 0.
Okay, so the coefficients themselves, taking away the addition and minus signs, could add up to anything.
I think that's right. Yeah, okay. There are. They go into this in a little more detail in the book, and they do. You can add some more constraints, like some more rules that these numbers have to follow. That changes it a little bit, and I don't remember off the top of my head how that works.
Okay.
But for the purposes of this model, I think this is all they're saying, that the columns have to add to 0, and so yes, the numbers can be anything.
Yes. So with the minus and addition signs, each of those columns, the coefficients of each of those columns, coefficients or the formulas, have to add to 0. This is wait. The first column has to add to 1.
Mm-hmm.
The rest of it have to add total to 0.
Yep.
So we're not just talking about just the coefficient. We're talking about the whole formula. We're talking about the whole rest of the line equals to 0.
Forget this part. Just imagine that for each one of these equations, we only have these first 2 terms.
Well, 1 minus 1 minus 0 equals 0. So we're talking about not just the coefficient. We're talking about the coefficient, negative coefficient times r is equal to 0. Well, no, the all 4 of them together equal to 0. So not I thought you were asking me the coefficient plus the negative plus the sign.
Yeah.
So negative 01, negative 11, plus 21, negative 31. Those coefficients add to 0, but I don't. So my instinct says that times the interest rate is what needs to add to 0.
Well, the thing is that you can put any interest rate here, and it can change, right? And so it needs to add to 0 before the interest rate.
Oh, okay. I kind of see that. Okay.
Yeah, so that when you multiply it by the interest rate, this whole thing still adds to 1.
Okay. I kind of get that. Yeah.
Okay. So that I'd say that is about covered it for the asset demands bit. So we have these 4 equations are for US residents, right? They can hold their wealth in these 4 forms. This is for the French people, this is for the Greek people, and they're all, there's a lot of parameters, right? Because there's 16 of these lambdas. So 16 times 3 is 48, I guess. So there's 48 parameters here.
Yeah, but they're just arbitrary. It's just they're arbitrary numbers that we are going to be told before we press go. There's no.
You could get them from the data, you could make them up, you could, whatever. But they come from outside the model, and they do obey the rules that we said, right? This first column has to add to 1 in each set. Each other column has to add to 0.
The coefficients plus the signs, yes.
Yeah, so there's some, and they can't really be negative, or like these especially cannot be negative. That wouldn't make sense, right? So there's some constraints on them, but not very much. The thing you were saying about like people just prefer French government bonds over Greek government bonds, that you could definitely encode that into which one or more of these coefficients for sure.
Yeah, that makes sense.
Yeah, and so that's like the bulk of the model right there. And that's a lot, isn't it? But the
this
rest
has been incredible. I feel like I finally walked through. I mean, I don't obviously have tons to learn, and I really need to look at that. I really need to read that book now. But I just feel like I can see where it's coming from. I can see, it kind of makes sense. It's not just this completely opaque thing.
Yeah, that's great.
Yeah, cool. So is that the minimum of what you wanted to go through?
Yeah, that was kind of where I wanted to get to, because that kind of took us a while to do this bit, but I feel like you see this again, right? The reason I knew how to do this is because that's in the book. I've seen this in models before, this like asset demand and this whole setup here. I've seen it before. You'll see it again. And so now that you get how that kind of works, that'll help you a lot, I hope. The rest of it, it's like there is some standard stuff here, but then also some stuff they do specifically for the model. Like right here, they're looking at like, how do we split up the central bank's profits? Or, how do we decide how many bills the government's going to issue? Things like that. So, yeah, I would say that got you a good chunk of the way. You might be able to figure out most of the rest of it yourself.
I need to listen to this and write notes, and I need to read that book. This has been invaluable, let alone way above and beyond what we planned on doing. So, I mean, thank you. Sheesh. All right. Is there anything anything else left to say regarding that?
I mean, it looks like a cool model. Maybe I'll like read the paper in more detail later.
Yeah, no, we're reading it. We were assigned this in our 10th week of Torrens, and it's obviously foreign exchange in euro. Yeah, now I need to read this. I need to read the paper all over again. All right, wow, okay. All right, well, unless there's anything I'm going to say, I'm going to stop the recording. Thank you, Sam.
Yeah, you're welcome.
All right. Music for this show is by RecTech. You can find RecTech on SoundCloud and Spotify at WRECK_TECH. To record Activist MMT, I use the iOS phone app Tape-A-Call Plus for recording phone calls and Zencaster for internet-based recordings. My post-production workflow starts by editing on the iOS app AnyTune Pro Plus, then transferring those timestamps to my Windows desktop. At that point, I crudely process the audio in Audacity and then implement the edits and do all of the final processing in the Reaper digital audio workstation. Activist MMT is hosted by Libsyn, and the video teasers are created with the online Headliner app.